projections. So I'm going to go into the clients page and click Add New Client. We'll be creating a series of projections today for our client who's Olivia Garcia. They were born 1972 and they currently live in British Columbia. As you're likely aware, in the top left corner of Snap, there are three main sections that you progress through when creating a plan. The scenario setup, where you enter in your base plan data, the planning pages where all of that information comes together, where you can then customize for any year or period of time throughout the plan, and then the client report, where you can select what charts, tables, and commentary to include in a final PDF. One important note is that you can click on any of these at any time to navigate directly to that section of the software. I'll click Next to go to the general settings page and continue on with the scenario setup. At the top, you'll see we actually have a pop-up banner, and if you click on the teal blue box for Use Guidelines, that will import the most recent FP Canada guidelines that were published at the end of April this year. So that has updated the cash, fixed income, and equity gross rate of return values. As a reminder, you want to reduce these values for any expected management fees. So I'm going to use 1%, 2%, and 5% as my base net of fee expected returns. Going back up, we're going to start the plan as of 2024 with a target retirement age of 60, a projection length of 100, and we'll use the default inflation rate of 2.1. I'll click Next and go to Expenses. Olivia is targeting $80,000 a year of base after-tax cash flow once she retires. The base expense value is the amount of money that your client needs for items outside of the projection. So this is separate from taxes, debt payments, contributions. Anything that you've modeled within the plan has already been accounted for, and the base and additional expenses are for items outside of the plan. We can also add an additional expense for an extra travel budget of $10,000 a year, indexed to inflation, starting at age 60 until age 74. We'll also highlight that so that in the chart, there's an explicit legend item calling out that goal so that we can show that it's fully funded. I'll click Next and go to the Incomes page. Typically, this is where I would input a client's employment income or other sources like rental income. In this case, I'm actually going to delete this input for the employment income because we're going to be adding Olivia's corporation and we're going to be paying her salary out of that corporate entity. So I'll skip the Incomes page and go directly to Assets. Here you can see Snap adds a non-registered account by default to all projections. This is to provide the software somewhere to allocate future surpluses. For instance, if you're downsizing a home or if the client has excess money in their RIF, this just allows Snap to allocate those surpluses into a financial asset to make the charts and tables more digestible. If the client already has a non-reg, you can of course delete the default account that's been added and input their own information. So we have a non-reg investment account, $50,000 value, $40,000 cost, and an asset allocation of 30% fixed income, 70% equity. We see that the rates of return are pulled from our general settings page, and then our total portfolio return is being calculated for us automatically. We can customize these rates on an account by account basis if we want, or we can leave those as our default. She also has a TFSA with 110,000 and an RSP with 325,000. Above the table of accounts, you'll see that there are tabs for each of the registered account types where we can customize additional settings. So I'll click TFSA and we can enter in if there's any carry forward contribution room. In this case, she just has the room available for the first year, so we'll leave that as is. And then for the RSP, we'll enter in her current room of $32,000. I'll go back to the assets page and then scroll down to the real asset section where I can input her home, which has a current value of $800,000, an original cost of $450K. We'll appreciate that with inflation. And we do have the option to purchase or sell a real asset in a future year. and then indicate if there's capital gains applicable to that transaction. I'll click next and go to debts to input her mortgage. That has a current balance of $145,000, interest rate of 5%, and monthly payments of $1,800. We can link that to the home so that if we sell the property at any time in the plan, the mortgage will be repaid if there's still an outstanding balance. I'll click next to go to the government benefits page. Here we can customize the start age and either enter in a dollar amount or a percentage of maximum. So we're going to start as of age 65 for our base case. And then we could input a dollar amount if they're currently receiving their CPP or if they have a Service Canada statement, or we can enter in an expected percentage of maximum. You'll see by default, it started with the national average of 55%, and then I can adjust that based off of my client's history of employment income. So here we have 75% as our assumption, and then we'll use OAS at 65 with 100% of the maximum. On the left, there are additional input pages that we could use. We could add insurance policies, conduct life needs analysis to see if more life insurance might be required. We can add RESPs, and then we can customize additional settings related to the plan to refine the assumptions to our client's unique circumstances. Or we can click corporations and input her holding and operating company as a single entity. So I'll do that. I'll click corporations and then add corporation. So here I can input her company name. It's registered in British Columbia and qualifies for the full small business deduction rates. As we scroll down, you'll see that we can enter in notional account balances that the client has as of today. If you don't have this information available, you can always leave the values as 0, and that's just going to create a more conservative projection without the tax advantages that these notional account balances provide. If you do have the information, that's great. You can input it, and it's just going to make the plan more accurate. As a note, you don't have to worry about tracking these going forward in the projection. SNAP will calculate the expected RDTOH, CDA, and GRIP. It's only the starting balances that you would input directly here. So I'm just going to enter in 15,000 for the RDTOH balance and 20,000 for the CDA. We can also customize the ownership and customize the assumptions that we want to use for disposing of the corporation. So whether we want that to happen post-mortem as part of the final estate, whether we want that being liquidated in a specific year of the plan, and then we can indicate whether we want the distributions happening through dividends or through a capital gain. I'll click next and go to the assets page to input the investment balance for the holding company, which is 500,000, original cost of 400,000, and a similar investment approach of 30% fixed income, 70% equity. On the left, once again, you'll see that we can input debts, insurance, and customize additional settings. We will run a projection shortly with an insurance policy added. So similar scenario setup capabilities that we saw on Olivia's personal side. Now that I'm done entering in all of my scenario setup information, I'm ready to proceed to the planning pages. Before I do that, I just want to pause and see if there have been any questions come in so far that we want to address before moving on in this plan.
Thanks, Steve. Basically just that we are recording this session, so there will be a link that is sent out afterwards. And that's it for now.
Yes, thanks, Lee. Awesome. All right, so we're done with our scenario setup. We'll click on planning pages, and that's going to allow us to view the information for the corporation first. So we have Evolve Design highlighted here. That's how we know we're in the corporate planning page. And these pages can be overwhelming the first time that you're interacting with them. The more you do, the more you know what you're looking at and how to navigate these pages, the more intuitive and powerful they become. On the left, we have the year and our client's age. We have the active business income. So this is essentially the operating business on the left. And then we have passive and investment income on the right. So this is the holding company. And it is recommended in SNAP to model both the operating business and holding company as a single entity so that they can communicate with one another related to notional account balances and the small business deduction. For operating income, she's currently earning $450,000 a year into the corporation and expects that to continue until her last year prior to retirement. She's paying herself $200,000 a year from the corporation as salary, and she's paying $50,000 a year in additional expenses. So now that we've made our edits on the planning page, you'll see in the top right that anytime that we make a change directly on this page, the Run Scenario or Run Corporation button turns red. It just means that the changes that you've made have not yet applied throughout the rest of the scenario. So we'll click Run Corporation to update all of the other numbers. And now that it's green, we know that we don't have to click it anymore. All the numbers are up to date and we can continue on with our planning. We now have the net operating and taxable income of $200,000. That's being added to the investment income and all being taxed at their appropriate rates. The tax is being subtracted from the proceeds, and then the net amount is being deposited to the investment account on an ongoing basis. As a result of all of those contributions and ongoing growth, we have the account reaching a total balance of about 2.4 million. Now that we're done setting up the pre-retirement period for the corporation, we can jump back to Olivia's personal planning page. From here, we can enter in her ongoing contributions to her personal accounts. As a summary of what's available on this page, we have, once again, the year and our client's age. We have the calculated discretionary cash flow that the client has available after accounting for everything else input in the plan. So this 112,000 of cash flow is being calculated by taking the salary of 200K, subtracting off CPP and EI, subtracting off taxes, and subtracting off her mortgage payments. So that leaves her with 112,000 available to allocate towards savings or for spending needs. I'll go to the RSP and enter in her current contributions of 32,000, copying that down and indexing until retirement. I'll also enter in her TFSA contributions of 7,000 a year and copy that down until retirement. Now, if I wanted, I could enter in a higher value. For instance, I could enter 10,000. And when I click Run Scenario, Snap is going to try to contribute 10,000 into the account, but it's going to look forward to each future year and see what the expected maximum is and only enter in that maximum amount. So now we've entered in our contributions. Snap has updated the discretionary cash flow remaining. We can then scroll down to retirement at age 60 and see the target spending of 80,000 a year, indexed for inflation, plus our travel budget. And then Snap starts automatically withdrawing from our personal investment balances until we run out of money at age 69. So at the moment, in order to use the corporate money in our retirement drawdown, we do need to enter those values directly on the corporate planning page. So if we go to Olivia, you'll see that you have the ability to pay eligible, non-eligible, and capital dividends. And all of these are governed by the available notional account balances for the corporation. So it won't allow you to pay out more than you would be able to. As a quick and simple illustration, I'm just going to come down to retirement and enter in a total of 70,000 being paid out from the corporation, indexed for inflation, all the way to the bottom of the plan. I'll click Run Corporation, and now we can see what the expected balance is available in the investment account each year of the corporation. So we can see it eventually starts to draw down on the principal, and then there's about 800,000 left in the final year. If I go back to Olivia's personal page, we can now scroll down and see that as a result of those increased dividends, less money is being taken out of the personal account. So Snap is automatically recalculating everything around those dividends. And as we scroll down to the bottom of the page, we can see that there's still about $1 million left over personally. So in about 15 minutes, we've created our first base projection for Olivia. We've been able to show that she is on track for her target retirement spending of 80,000 plus that additional travel budget. We could review it in other forms like the charts, where we can see things like the base expenses, her additional travel budget, income taxes, mortgage payments, and contributions to financial assets. We can also see where that money is assumed to be coming from each year of the plan. And we can see the net worth. And all of these charts are fully interactable. We can exclude things like the corporation and real assets to give her a sense of her personal liquidity. And then if we want, we can include any of these in our report. So I'm going to update the title of this scenario to base case. And then we're going to copy this plan and see whether there are ways that we could adjust the corporate distributions to help her to more appropriately achieve her future goals. So before I move on to the second plan, I just want to pause and see if there are any other questions coming in at the moment.
Thanks, Steve. I guess just we had one question from Roger actually about modeling OpCo and HoldCo in the same corporation versus multiple corporations, and just a little bit of discussion on that.
Yeah, so it can be done either way. The main advantage of doing it as a single entity is you'll see the retained earnings automatically deposit to the holding company. In addition, if we were earning operating income above the small business deduction rate, that would get automatically added to the GRIP. And then if we have passive investment income greater than 50,000, that's going to automatically reduce the small business deduction value for the OpCo. So by having it as a single entity, you really get to take advantage of all of that integration. If you would prefer, you can model it as two separate corporations and then just show the transfers going in between the corporations as you need. We do have other training material available in help with corporate articles, videos, and previous webinars that we've done that might dive further into that topic.
Terrific, thanks.
Awesome. I'll copy this plan and then we'll do a second scenario where we'll optimize those drawdowns. So retirement drawdown optimization. And what I'm looking for within the plan are things like the marginal tax rate. So if we're looking at the personal planning page, we can see the marginal tax rate while she's working is about 40%. Then that drops to 28% for the first decade of retirement, but then it spikes up to 38% for the rest of the plan. And in addition to the marginal tax rate spiking, we can also see that there's quite a bit of OAS clawback expected throughout this plan. So we can go to Evolve Design and we can change some of the dividend distribution assumptions. So we had that 5-year period prior to OAS and CPP kicking in where we could likely take out more money. So I'm going to increase the non-eligible dividend to 150,000, copy that down until age 64. So you'll see those dividends have increased. And then once the client turns 72, I want to reduce the non-eligible dividends because their RIF is going to kick in. And I want to start paying out capital dividends of about 40,000 a year. And that's just going to provide them with tax-free income. So now I'll run the corporation. I'll scroll down towards the bottom of the page, and we'll see that Snap is automatically limiting my capital dividends if required in order to prevent me from overpaying from the expected notional account balances that would be available in that year. And we can track those from the balances table here, where it shows the GRIP, CDA, and RDTOH values for each year of the projection. So now that we've changed the distribution strategy, we can go back to Olivia's personal page and see whether that's helped. So now we have higher dividend payments here. We can see that that's resulting in a slightly higher marginal rate for the first 5 years. But then from 65 onwards, we're at that 28% consistently throughout the plan. And we've also almost entirely eliminated the OAS clawback. So now to see whether this is truly advantageous for the client, we can go to the estate before tax column, click on the final year's value, look at the expected estate after tax amount, click compare with other scenarios, and we can see that in our previous case, we were leaving her with about 3.8 million in the final estate versus 4.4 million with these optimizations. So this is both how you can refine a plan and then compare and show the value that you've added. These sorts of optimizations and steps towards a more optimal plan are on our roadmap to continue to add automation tools to help save time when doing this, but this is the process that you and those tools will follow. So now that we have our optimized scenario, I'm going to copy it once more, and we're going to show Olivia what would happen to her plan if the proposed capital gain rate changes go forward from the most recent budget. So I'm going to retitle this plan, Scenario 3, Proposed Capital Gains Inclusion Rate Impact. Now, as a default, because these proposed changes have not yet received royal assent, the software is still currently using 50% for all of its base projections, but we've added within the scenario setup settings income taxes page the ability to experiment by introducing the proposed capital gains rules now. And this was primarily done because there are some potential planning opportunities ahead of the June 25th proposed date, and because some clients are quite interested what the impact would be on their plan. So instead of having it never applied, you can click on that and either immediately start it in 2024 of your plan. This will assume that all capital gains that are realized in the projection are done at that higher inclusion rate, or you can do it as of 2025. And this would allow you to model transactions occurring in 2024 prior to the June 25th cutoff. So this would essentially allow you to compare a scenario where you liquidate part of their portfolio at the lower rates and compare that to another scenario where you liquidate it in the future at higher inclusion rates. So in this case, because I'm not doing any analysis for the immediate year, I'm going to start with 2024. That's going to assume that all gains are at that higher rate. And I'll go back to the planning page to see the impact. So there's a few ways that I can kind of see the impact of the higher taxes. I can go to the corporation, go to the taxable investment income column, and then click on the detail expansion. So here the capital gains are now higher. They're the 66% inclusion instead of 50%. And then if we look at the notional account balances, the amount of CDA that they're receiving is only a third instead of half of the gain. So as a result, we can see, there's less capital dividends being paid out in this plan because the room runs out earlier. And if we go back to Olivia's personal planning page, we can scroll to the very bottom and see that as of the final year, her after-tax estate has dropped to about 4.1 million. So as a result of the higher taxes, she's lost about 360,000 from her expected estate. So we can show her, even though the proposed changes will impact her taxes and her plan, she is still well funded and ahead of plan for her target retirement. So we can provide that reassurance. So with the proposed changes coming down, clients might be interested in considering alternative strategies for their corporations. In this case, with Evolved Designs, we can see that there is surplus expected at the end of the plan that they don't need for retirement spending. So we can copy this plan and do one final scenario where we illustrate use of a corporate insurance policy to see whether that might be advantageous for her goals. So I'll just update the title. Scenario 4, use of corporate insurance. I'm going to enter the corporation, go to scenario setup, and then insurance. I'll add a new corporate policy. It'll be a whole life insured on Olivia. And then when I click on edit death benefit, you'll see that there's an input table available. And you can actually copy and paste directly from Excel or an insurance quote provider directly into the software. So I've just copied from another Excel table and I can paste the death benefit, cash surrender value, cost base, and premium directly into the software. So now that we have the policy added, you can see on the planning page all of the details related to that corporate policy. We can also see that the premium is being deducted from the cash flow before it's deposited to the financial assets. As a result, there's less money for investment purposes, and that leaves a slightly lower surplus in the financial assets as of the final year. So once more, we'll go to Olivia's personal page, scroll to the very right-hand side to the estate before tax. And in the final year, we can see whether this would be advantageous for her case. So here, 4.7 million compared to 4.1. So for her specific use case and our expected insurance quote, it would be advantageous if she lives to this life expectancy to proceed with that strategy. So This is a way that you can illustrate different alternative investment approaches, whether it's changing the portfolio settings, the asset allocation, or anything else. You can show your clients how they might navigate their corporate entity going forward. So now that we're done our 4 projections and we have our recommended scenario, which will be this scenario 4, we're ready to proceed to the client report, where we can select the charts, tables, and commentary that we want to ultimately include and share directly with our client.